strong fundamentals together with financial stability and positive growth momentum. Nevertheless, we need to remain vigilant in an unsettled global environment. The new realities brought about by technological advancements, supply chain realignments, trade and financial fragmentation, and climate change pose opportunities as well as challenges. In this milieu, India looks ready to embark upon a new era of transformation aided by a favorable demography, improving productivity and technology, and a conducive policy environment. The confluence of these factors brightens the prospects of sustained high growth in India in the years ahead. As the Reserve Bank approaches its centenary year, that is RBI at 100, it will gear up even more to remain future ready for India's fast growing economy. It will take steps to enhance India's global footprint. For our journey during the next decade, we have drawn up strategies consisting of policy actions towards positioning the Reserve Bank as a model central bank of the global South. The agenda for the run-up to RBI at 100 is documented in the annex to this statement. I urge all keen observers of the Indian economy and the financial system to take a close look at these action plans. This is not a static document. It cannot be a static document, as we are living in a dynamic world. Our endeavor will be to continually update it as may be required from time to time. I would now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. The inflation growth balance is moving favorably. Growth is holding firm. Inflation continues to moderate, mainly driven by the core component, which reached its lowest level in the current series in April 2024. The deflation in fuel prices is ongoing. Food inflation, however, remains elevated. While the MPC took note of the disinflation achieved so far without hurting growth, it remains vigilant to any upside risks to inflation, particularly from food inflation, which could possibly derail the path of disinflation. Hence, monetary policy must continue to remain disinflationary and be resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Sustained price stability would set strong foundations for a period of high growth. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The MPC also decided to remain focused on withdrawal of accommodation to ensure anchoring of inflation expectations and fuller policy transmission. I would now like to provide an assessment of the growth and inflation conditions. Let me first briefly touch upon global growth. Global growth is sustaining its momentum in 2024 and is likely to remain resilient, supported by rebound in global trade. Inflation is easing, but the final leg of this disinflation journey may be tough. Central banks remain steadfast and data dependent in their fight against inflation. Market expectations regarding timing and pace of interest rate cuts are also changing with incoming data and central bank communication. US dollar and sovereign bond yields remain range bound. While gold prices have surged on safe haven demand, equity markets have gained in both advanced and emerging market economies since the last MPC meeting in April. Let me focus now on the domestic growth conditions. The provisional estimates released by the National Statistical Office, NSO, placed India's real gross domestic product, that is GDP growth, at 8.2% for the year 23-24. During 24-25, that is during the current year so far, domestic economic activity has maintained resilience. Manufacturing activity continues to gain ground on the back of strengthening domestic demand. The 8 core industries posted healthy growth in April 2024. Purchasing Managers Index, that is PMI in manufacturing, continued to exhibit strength in May 2024, and it is indeed the highest globally. Services sector maintained buoyancy as evident from available high-frequency indicators. PMI services stood strong at 60.2 in May 2024, indicating continued and robust expansion in activity. Private consumption, the mainstay of aggregate demand, is recovering and it is recovering with steady discretionary spending in urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. Investment activity continues to gain traction on the back of ongoing expansion in non-food bank credit. Merchandise exports expanded in April with improved global demand. Non-oil, non-gold imports entered positive territory. Services exports and imports rebounded and posted a strong growth in April this year. Looking ahead, the forecast of above normal southwest monsoon by the Indian Meteorological Department, that is IMD, is expected to boost Kharif production and replenish the reservoir levels. Strengthening agricultural sector activity is expected to boost rural consumption. On the other hand, sustained buoyancy in services activity should continue to support urban consumption. The healthy balance sheets of banks and corporates, government's continued thrust on capex, high capacity utilization, and business optimism augur well for investment activity. External demand should get a fillip from improving prospects of global trade. Taking all these factors into consideration, real GDP growth for the current financial year 2024-25 is projected at 7.2%. Let me repeat, the GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. The risks are evenly balanced. I would now like to focus on inflation. CPI headline inflation softened further during the months of March and April, though persisting food inflation pressures offset the gains of disinflation in core and deflation in fuel groups. Despite some moderation, pulses and vegetables inflation remained firmly in double digits. Vegetable prices are experiencing a summer uptick following a shallow winter season correction. The deflationary trend in fuel was driven primarily by the LPG price cuts in early March. Core inflation softened for the 11th consecutive month since June 2023. Services inflation moderated to a historic low, and goods inflation remained contained. The exceptionally hot summer season and the low reservoir levels may put stress on the summer crop of vegetables and fruits. The Rabi arrivals of pulses and vegetables need to be carefully monitored. Global food prices have also started inching up. Prices of industrial metals have registered double-digit growth in the current calendar year so far. These trends, if sustained, could accentuate the recent uptick in input cost conditions for farms. On the other hand, the forecast of above normal monsoon bodes well for the Kharif season. Wheat procurement has surpassed last year's level. In fact, the buffer stocks of wheat and rice are well above the norms. These developments could bring respite to food inflation pressures, particularly in cereals and pulses. The outlook on crude oil prices remains uncertain due to geopolitical tensions. Assuming a normal monsoon, CPI inflation for 2024-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. So thus, as you can see, the GDP growth projection, we have increased it from 7%, which we gave out in the last MPC meeting. We have increased it to 7.2%, and the inflation projection, the average for the year, we have retained it at 4% as 4.5% as it was in the last MPC meeting. And I have explained there are good reasons why we have increased the GDP forecast, the GDP projection for the current year. Now, what do these inflation and growth conditions mean for monetary policy? That is the question, and I would like to answer that. The developments relating to growth and inflation are unfolding as per our expectations. When the projected GDP growth of 7.2% for 2024-25 materializes, it will be the fourth consecutive year of growth at or above 7%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in headline inflation, but this is likely to be one-off on account of favorable base effects and may reverse in the third quarter. If you look at the projections we have given, then it becomes very clear that in the second quarter, the headline inflation is likely to come down to about 3.8%, and thereafter again it goes up. And we have given the numbers in the statement, and I have already read it out earlier. At the current juncture, therefore, the uncertainties related to food price outlook warrant close monitoring, especially their spillover risks to headline inflation. In parallel, the behavior of the core component also needs to be watched carefully. We need a descent of inflation to 4% target on a durable basis while supporting growth. Now, there is a view that in matters of monetary policy, the Reserve Bank is guided by the principle of follow the Fed. I would like to unambiguously state that while we do keep a watch on whether clouds are building up or clearing out in the distant horizon, we play the game according to the local weather and pitch conditions. In other words, while we do consider the impact of monetary policy in advanced economies on Indian markets, our actions are primarily dependent and primarily determined by the domestic growth inflation conditions and the outlook. I have said this several times earlier, but it becomes necessary to restate the position and reiterate this so that there is clarity in the mind of market participants and other stakeholders, and as a result of which they do not board the wrong bus. Liquidity and financial conditions, that is the next part which I would like to highlight. During the current financial year so far, system liquidity transited from surplus to deficit conditions and then again back to surplus in early June. In consonance with the commitment made in the April policy statement of remaining nimble and flexible in liquidity management, and in view of the shifting liquidity dynamics, the Reserve Bank mopped up surplus liquidity through variable rate reverse repo auctions, that is VRRR auctions, during the first half of April, while injecting liquidity through variable rate repo operations, that is VRR operations, in the latter part of April and in May. In the first week of June, however, VRRR auctions have been conducted. Banks' recourse to the marginal standing facility, that is MSF, under the liquidity adjustment facility remained low during 2024-25, that is in the current year so far. Now, mirroring the liquidity dynamics which I just explained, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Now, I have explained, I mean for common listeners and for others, I have explained what exactly the corridor means in the footnote. And let me also state here that lot of, most of the statements which I am making are backed by data, and the data is given in the footnotes, and I would encourage you to have a look at footnotes to understand why we are making certain statements. So, mirroring the liquidity dynamics, as I said, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Across the term money market segment, the yields on certificates of deposit, that is CDs, commercial papers, that is CP, issued by non-banking financial companies, that is NBFCs, and 3-month treasury bills, that is T-bills, also eased. In the credit market, monetary transmission remains ongoing. As you would be aware, the Central Board of the Reserve Bank decided to transfer rupees 2.11 lakh crore as surplus to the central government for the accounting year 2023-24. As the economy remains robust and resilient, the Central Board decided to utilize this opportunity to increase the risk provisioning under the contingent reserve buffer to 6.5% of the Reserve Bank's balance sheet for 2023-24 from 6% in 2022-23. In other words, the contingent reserve buffer, which was 6% in 22-23, was enhanced by the Central Board to 6.5% in the current for the year 22-23. Now, this risk provisioning, that is this provision for contingent reserve buffer, or CRB as we call it, this would further strengthen the Reserve Bank's balance sheet. Prudence is at the core of our standard operating procedure. The Indian rupee moved in a narrow range with a low volatility during 2024-25 so far, that is up to June 5th, and that's the figure I have given. Now, this has happened despite the rupee trading under pressure amidst foreign portfolio, that is FPI outflows. The relative stability of the Indian rupee bears testimony to India's sound and resilient economic fundamentals and its macroeconomic and financial stability and improvement in the external outlook. Looking ahead, the Reserve Bank will, and I'm providing some kind of a forward guidance here with regard to liquidity and our approach to the markets. Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. I would like to read this sentence once again for clarity. And it's not just for clarity, but to reiterate the position. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. And this is consistent with our approach, which we have been adopting. Even during COVID times, we adopted the same approach, and thereafter we have continued. So therefore, our focus is to ensure stability and orderliness in all segments of financial markets and institutions which are regulated by the Reserve Bank. I would now turn to financial stability. The annual financial results of 2023-24 indicate that the banking system remained sound and resilient, backed by improvement in asset quality, enhanced provisioning for bad loans, sustained capital adequacy, and rise in profitability. The non-banking financial companies, that is NBFCs, also displayed strong financials in line with the banking sector. Notably, the gross non-performing assets, that is the GNPAs of scheduled commercial banks and NBFCs, are below 3% of total advances at the end of March 2024. It is important that regulated entities should continue to improve their governance standards, risk management practices, and compliance culture across the organization. In November last year, we had flagged certain concerns on excessive growth in unsecured retail loans and over-reliance of NBFCs on bank funding. Recent data suggests that there is some moderation in these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. The boards and top management of regulated entities should ensure that risk limits and exposures for each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between asset and liabilities has to be maintained. Customer protection remains on top of the Reserve Bank's priorities. In general, we have observed that the guidelines on key fact statement, in fact, I have explained key fact statement also in the footnote. The customer protection, as I'm just repeating, customer protection remains on top of Reserve Bank's priorities. In fact, it would be of interest to you that in this year's annual report, we have a separate box item which lists out the customer-centric measures that the Reserve Bank has taken. And in the same vein, we have also a box item in the annual report which has just been released recently. There is a box item on the number of regulatory measures which were taken after carrying out stakeholder consultations. And these two box items, I would encourage those who are interested to please have a look at them. So in general, we have observed that the guidelines on key fact statement are followed, but a few regulated entities still charge fees, etc., that are not specified or disclosed in the key fact statement, that is KFS. It has also been observed that in some microfinance institutions and NBFCs that the interest rates on small value loans are high and appear to be usurious. The regulatory freedom enjoyed by the regulated entities in respect of interest rates and charges should be used judiciously to ensure fair and transparent pricing of products and services. The Reserve Bank continues its constructive engagement with such financial entities to safeguard the interest of customers and ensure overall financial stability. Now let me make it very clear that we are observing all these trends, and our focus is always to interact, to engage with the sectoral players, to engage with the individual banks or NBFCs or the MFIs, and encourage them to take necessary corrective measures, because it's for the regulator and the regulated entities together. We have to work to ensure that your health, that is the health of the banks and NBFCs and the microfinance institutions, remain robust, the health remains good, and if that happens and when that happens, it's good for the economy. I'm not saying that there is any big amount of problem at the moment. Overall, as I have said, let me again re-emphasize the banking sector, the NBFC sector, the MFI sector, overall financial sector remains healthy and stable. But there are a few outliers and I was mainly focusing on them. Let me now turn to the external sector. With lower trade deficit, robust services export growth and strong remittances, the current account deficit is expected to have moderated in Q4 2023-24. Services exports were predominantly driven by software exports. Other business services and travel services exports were predominantly driven by software exports, other business services and travel exports. The phenomenal rise in global capability centers, that is GCCs, in India has provided a significant boost to India's software and business services exports. India, with an expected 15.2% share in world remittances in 2024, continues to be the largest recipient of remittances globally. Overall, the current account deficit for the current year, that is 2024-25, is expected to remain well within its sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, surged in 23-24 with net FPI inflows of around US dollar 41.6 billion. Since the beginning of 2024-25, however, foreign portfolio investors have turned net sellers in the domestic market with net outflows of US dollar 5 billion till June 5. In 2023, India retained its position as the most attractive destination for greenfield foreign direct investment, that is greenfield FDI in Asia and Pacific. Gross FDI remained robust in 23-24, but net FDI moderated. External commercial borrowings, that is ECBs, and non-resident deposits recorded high net inflows as compared with the previous year. The amount of ECB agreements also grew markedly during the year. Now, I have given the relevant data in the footnotes. Now, touching a new milestone, India's foreign exchange reserves reached a historical high of US dollar 651.5 billion as on 31st May. India's external sector remains resilient and the key external vulnerability indicators continue to improve. Overall, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures, and there are, I think, about there are few of them, and at the end, in the concluding para, I would like to also provide some guidance for the way forward. The first announcement relates to review of limit for bulk deposits in banks. On a review of bulk deposit limit, it is proposed to revise the definition of bulk deposits as single rupee term deposit of 3 crore, rupees 3 crore and above for scheduled commercial banks, excluding the regional rural banks, and this also is applicable, that is from this definition of single rupee term deposit of 3 crore is applicable to both scheduled commercial banks and SFBs and not RRBs. Further, it is also proposed to define the bulk deposit limit for local area banks as single rupee term deposit of rupees 1 crore and above as applicable in the case of RRBs. The next announcement relates to rationalization of guidelines for export and import of goods and services under the Foreign Exchange Management Act, that is FEMA 1999. In view of the changing dynamics of international trade and in line with the progressive liberalization of foreign exchange regulations, it is proposed to rationalize the extant FEMA guidelines on export and import of goods and services. This will further promote ease of doing business and provide greater operational flexibility to authorized dealer banks. Draft guidelines will be issued shortly for stakeholder feedback. The next announcement relates to setting up of a digital payments intelligence platform. The Reserve Bank has taken a number of measures over the years to deepen digital payments while ensuring their safety and security. These measures have boosted consumer confidence. Growing instances of digital frauds, however, highlight the need for a system-wide approach to prevent and mitigate such frauds. It is therefore proposed to establish a digital payments intelligence platform for network-level intelligence and real-time data sharing across the digital payments ecosystem. To take this initiative forward, the Reserve Bank has constituted a committee to examine various aspects of setting up this platform. The next announcement relates to inclusion of recurring payments with auto-replenishment facility under the e-mandate framework. The adoption of e-mandates for recurring payment transactions has been increasing. It is now proposed to include payments such as replenishment of balances in FASTag, National Common Mobility Card, that is NCMC, etc., which are recurring in nature but without any fixed periodicity in the e-mandate framework. This will enable customers to automatically replenish the balances in FASTag, NCMC, etc. if the balance goes below the threshold limit set by them. This will enhance convenience in making travel and mobility related payments. The next announcement relates to introduction of auto replenishment of UPI Lite wallet, and it also includes inclusion under the e-mandate framework. UPI Lite was introduced in September 2022 to enable small value payments in a quick and seamless manner through an on-device wallet. To encourage wider adoption of UPI Lite, it is now proposed to bring it under the e-mandate framework by introducing a facility for customers to automatically replenish their UPI Lite wallets if the balance goes below the threshold limit set by them. There could be some, I think if you want better clarity, this statement will be uploaded immediately after my, my address, my statement is over in the next couple of minutes. So please have a look at the uploaded version, that will give you clarity. We try to avoid long sentences, but sometimes it becomes difficult and so unavoidable. So please bear with me. Now this measure will further enhance the ease of making small value digital payments. And the final announcement relates to Harbinger 2024, Innovation for Transformation. The Reserve Bank has taken several pioneering initiatives in recent years to encourage innovation in the fintech sector. One such key initiative is the global hackathon, that is Harbinger Innovation for Transformation. The first two editions of the hackathon were completed in the year 2022 and 2023. The third edition of the global hackathon, Harbinger 2024, with two themes, namely Zero Financial Frauds and being Divyang Friendly, will be launched shortly. Let me now conclude. At the Reserve Bank, our job demands poise, patience and perseverance. India's recent economic progress, continued momentum in economic activity and the overall promising economic prospects validate our approach to policy making. At the moment, the Indian economy is at an inflection point in its path towards greater transformational changes that will bring about more stability and growth. On inflation, we are on the right track, but there is still work to be done. Globally, there are concerns that the last mile of disinflation might be protracted and arduous amidst continuing geopolitical conflicts, supply chain disruptions and commodity price volatility. In India, with growth holding firm, monetary policy has greater elbow room to pursue price stability to ensure that inflation aligns to the target on a durable basis. In the current setting, In its current setting, monetary policy remains squarely focused on price stability to effectively anchor inflation expectations and provide the required foundation for sustained growth over a period of time. The words of Mahatma Gandhi resonate here, and I quote, "If we are sure of our path," I repeat, "if we are sure of our path, we should go on striving for it incessantly and uninterruptedly." Thank you. Namaskar.
Good afternoon, ladies and gentlemen. Welcome to Market Masters, our special show on business today, where you get to